A popular scalping strategy claims that if the first 5-minute candle of the day opens at its low, the stock will go up. If it opens at its high, it'll go down. Institutions reveal their hand in the first 5 minutes, so I tested it on 10 stocks over 10 years. And the prediction part, it actually works. 63 to 70% of the time, it's right. But when I tried to trade it, that's where things fell apart. The strategy is simple. Look at the first 5-minute candle of each trading day. If the open equals the low within a small tolerance, that means buyers stepped in immediately. Bullish signal. Go long. If the open equals the high, sellers took over immediately. Bearish signal. Go short. I tested 4 tolerance levels from 0.01% to 0.25%, multiple risk-reward ratios, direct entry versus a 50% Fibonacci retracement entry, and end-of-day exits. Let's start with the direction prediction. At 0.05% tolerance on SPY, open equals low, appeared 962 times, and predicted a green day 62.5% of the time. GOOGL was the best at 69%. AMD had the best short prediction at 70.1% for open equals high days. Across all 10 stocks, the prediction accuracy ranged from 56 to 70%. That's significantly better than a coin flip. The first candle does contain directional information. But can you trade it? The best configuration was 1.5 to 1 risk-reward with direct entry at 0.25% tolerance. Profit factor, 1.17. That means for every dollar you risked, you got $1.17 back. After commissions and slippage, that edge shrinks to nearly zero. Most configurations landed between profit factor 1.00 and 1.15. You'd need to trade thousands of times to see any meaningful profit, and one bad week could wipe months of gains. The conservative variant from the video says to wait for a 50% Fibonacci retracement of the first candle before entering. The theory is that you get a better entry price and avoid whipsaws. The data says the opposite. The Fib entry reduced win rates by 5 to 10 percentage points and made most configurations unprofitable. Why? Because strong moves don't pull back. When the first candle signals a direction, waiting for a pullback means you miss the moves that work best. Tolerance matters more than you'd think. At 0.01%, meaning the open has to be almost exactly at the high or low, you get very few signals. At 0.25%, you get 2,000 plus signals, but the quality drops. The sweet spot was 0.10%. Enough signals to be tradable, with direction accuracy still around 65%. But even at the best tolerance, the profit factor never exceeded 1.17. So, here's the bottom line. The first candle does predict the day's direction significantly better than random. That part of the claim is true. But predicting direction and making money are two completely different things. A 65% directional edge with a 1-to-1 risk-reward should be profitable in theory. In practice, the edge is so thin that commissions, slippage, and the occasional gap move eat it alive. This is a strategy that works in a spreadsheet, but not in a trading account. The lesson: always test strategies with real trading costs in mind. A profit factor under 1.2 is dangerous territory. If you want to see more strategies stress-tested with real data, subscribe and hit the bell. Drop your strategy in the comments. Data doesn't lie.